Of all the three main factors for stock, quality, value, and momentum, we think momentum is a very important timing factor. It just tells you if a stock is at the right time to buy or sell. Because how we define momentum is by its relative performances to market expectations. So if a company is doing very well and better than market expectation, its momentum will be very high. And in the contrary, if the company is disappointing and missing its operations against market expectations, its momentum will be very low. And here how we define market expectations is by the revenue and earnings revisions from the sell-side analysts. So collectively, we have a pool of financial estimates from the sell-side analysts working in companies such as Goldman Sachs or Morgan Stanley. And at the same time, company provides guidance for the next quarter or the next year when it comes to their financial performances such as revenue and net profits. So when a company by each quarter or each year reports better than expected results, that will lead to the upward revisions of estimates for revenue and net profits. And when a company sees those upward revisions, its momentum rank will go up. Once again, we use Apple as the first example here. As you can see, of all the 7,610 stocks we covered today, Apple's momentum rank is at 1,536. And that almost puts Apple into the top 20% of the momentum universe by missing just a bit. As we're making this video now, Apple has just released its iPhone 13 and a variety of other products. And from the pre-bookings of those new products, the expectations for its upcoming revenue and net profits numbers are going up. Hence, we're seeing positive revisions to its forecasts. And scroll down to the momentum section, you can see Apple's momentum rank by different categories. Once again, there are three subfactors that contribute equally 1/3 to the final momentum rank. And they are revenue, earnings, and sentiment. Again, what goes into the underlying calculation has more than 30 data points. For example, for the revenue revisions number here, we use last 7 days, last 2 weeks, 4 weeks, 3 months, and 6 months. So not a single time frame will dictate in the final calculations. And the same goes with the earnings and sentiment. And here by sentiment, we mean the number of buy, sell, and hold recommendations from the sell-side analysts. And we measure the change of that ratings distribution of buy, sell, and hold from time to time. And here, as you can see, Apple's revenue, earnings, and sentiment rank is all pretty consistent at around 2000 level. And that nicely puts Apple in the top 20 to 30% bucket. So across the board, we show strong as the label for Apple's revenue, earnings, and sentiment rank, as well as the final main factor, momentum rank. And let's also take a look at Exxon Mobil, whose momentum rank today is at 241. So for a pretty traditional old-fashioned oil and gas company like Exxon Mobil, why its momentum rank is so high? As we know, during the time that I created this clip, globally we're having an energy shortage and oil prices going up and fuel prices going up. And as one of the largest integrated oil and gas companies globally, Exxon Mobil is seeing positive revenue and earnings revision as well as sentiment changes across the board. And with our historical ranking chart for the last 12 days, you can see Exxon Mobil's momentum rank has increased dramatically in the last couple of days, from number 1100 on the 29th to today's 241 on the 11th. So this is our momentum rank. Again, similar to quality and value, it's all about comparing different stocks based on these ranks. And you can easily find two different stocks that may be quite well known, such as Apple and Exxon Mobil, but it's quite important to know specifically now, is the company doing well or not? And more importantly, how does that compare to expectations? That's why we say using momentum as a sort of time indicator and gear your attention towards those companies who are doing well and avoid companies who are seeing negative revisions. Because since they are missing market expectations, timing is not in your favor. And you want to choose a company that is doing well operationally, better than market expectations, and ride with that operating momentum.